So let's hear from Trevor Greetham, Director of Asset Allocation at Fidelity Worldwide International and Portfolio Manager of Fidelity's multi-asset fund. He manages approximately $11 billion in assets, and I presume it is all about Europe as far as you're concerned. And we were suggesting earlier that you're looking maybe into a U-turn in government intervention.
Yes, I mean, it's all about Europe at the moment in terms of the news flow, but it's worth remembering that there was a global slowdown underway, probably peaking out something like the second quarter of the year. Since then, growth has been slowing, and every time in the last few years we've had a slowdown, the markets have gone straight for the jugular in the peripheral European economies because they're the weak link globally. And it's not really a Europe problem that caused this slowdown, it was just a lack of stimulus.
It's a double whammy, really, isn't it?
And now it's feeding back on itself. So you do need the policymakers to blink, you need stimulus and growth in the world, as well as the intricacies of Europe to be fixed. And at the moment, my feeling is you need fiscal as well as monetary intervention.
So how has your investment policy changed? You are presumably underweight in stocks at the moment.
Yes, we're underweight in stocks. The portfolios include commodities in their benchmarks as well. We're underweight commodities. We're underweight the Australian dollar. We're underweight Europe. The sort of safe areas, if you like, are global government bonds. Gold was still overweight, and also we're overweight US equities in an equity context because America has at least proposed a fiscal stimulus package. Whether it gets through intact or not, we'll see. But if things are carrying on like this, nobody will oppose it.
No, well, you mentioned government bonds, and I'm just wondering about which ones exactly. I mean, if you look at Gilt here in the United Kingdom, do you think they are as safe a haven as the yields might suggest?
I don't like the term safe haven. I think
you know what I mean. You know what I'm saying.
My point is that the dynamics of the UK are so different from the dynamics of, say, Greece. And it's gone beyond safe haven. If your bond yields are 3, you're a safe haven. If your bond yields are heading towards 2 and under 2, you're heading into deflation. And I think the gilt yields we're seeing at the moment are talking about death, destruction, deflation. It's not something to be proud of that our yields are so low in the UK.
And that's why you're still overweight then in gold. Do you think there's plenty more rally for that to continue going on? To what sort of price, do you think?
Well, I wouldn't put a price level on gold, but it's government bonds and gold as the more defensive trades in this environment. Although gold I have moved back from a little bit, because I think if you remember in the first half of 2008, gold prices did correct somewhat. And that was sending a deflation warning signal to the central banks. I mean, we were seeing the same sort of thing at the moment. The central banks have to print some more money, and I think the countries with the very low bond yields, you mentioned the UK, but the US, Germany, Japan even, I think they have scope to loosen fiscal policy. And it isn't crazy, because the debt we should all be worried about is private sector debt backed by asset prices. Debt deflation is the enemy, and this is a time when Keynes would have said that the governments need to spend money because no one else will.
Well, you mentioned QE and monetary easing. What about the inflation risk? Because that certainly is a major issue here in Europe and America too, really.
Well, I mean, you've got commodity price inflation. Personally, I think QE on its own is flawed. So it's pushing up commodity prices, it's holding up certain asset prices. For the average person, it's just increasing their cost of living. So it's not stimulating the average consumer. This is why I think you need this combination of governments spending money that central banks have printed for them. And I think we will eventually see it, but I hope it will happen sooner rather than later.
And what about property prices as a sort of indicator of growth? I mean, do you think that's an area that's been overlooked, notably in the United States? Because a lot of people a year or so ago are saying nothing's going to get better in the United States unless property prices recover. Well, they're not going anywhere particularly, are they? So it's kind of been brushed under the carpet. Are you still sort of quite pushing that?
Yeah, certainly am. I mean, I have a graph I always include in my presentations that shows Japanese land prices, which have been falling every year since 1990. And Japanese bond yields and discount rates. And as long as property prices are drifting lower in the US and the UK, interest rates are stuck at 0. And that's what central banks and governments need to do. They need property prices to stay where they are or even rise somewhat. And that starts to allow people to sort of grow into their debt burden rather than default into it.
OK, Trevor Greetham, we've got to leave it there, Director of Asset Allocation and Portfolio Manager at Fidelity Worldwide Investment. I'm grateful to you. Thanks very much indeed for coming in.